Welcome to Capital Insights. Thanks so much for being with us today. We very much appreciate your time. We wanted to talk about today the recent vote in Britain to leave the European Union. A little bit of melodrama, both in the global economy and in the financial markets. What does it all mean? We thought we'd run through both the fundamental side and the side of that decision that may relate to the markets and really the global markets over time. So as we look at Britain, the EU, the European Union, has been around for decades now. And it was really put together, if you will, to support trade among all the European countries that are out there. So with Britain leaving the EU, what this really does fundamentally is it opens up a number of questions that will be resolved over the next year or so. And it's really trade agreements. What will the new trade agreements look like between England and its compatriots in the EU, etc.? And it's very important because a lot of foreign companies have their headquarters domiciled in England. So if there's any kind of trade negotiations, any kind of change in trade, it could very well impact the greater global economy than just Britain itself. About 30% of Britain's GDP is really trade related. So it isn't the entire economy by any means, but 30% is a big number. And within that, about 15% of their GDP is trade being done with the European Union itself. So what's really at risk here? What's up for negotiation? What's really at risk here is about 15% of Britain's GDP. It's not the end of the world, and we need to know that a lot of European countries need Britain just as much as Britain needs them. So from an economic impact standpoint, we're really going to have to see how this plays out over the next year or two, because we've got some time before Britain officially leaves the EU itself. One other stat or fact that's kind of important is that 50% of the direct investment in Britain, money coming into Britain, investing in Britain, really comes from the EU itself. Again, a lot of foreign countries have their headquarters domiciled in London, and London is basically the undisputed financial capital of Europe. So many Euro securities trade through London, it isn't funny, and you may have seen that even some of the big brokerage houses like Goldman and Morgan, are reassigning people to Frankfurt from London. Why was that happening? Well, they're a little bit scared of what the new rules may look like. So that's a big deal for England too, is that a lot of investment has really been related to its, if you will, inclusion in the EU and its ability to trade euro-based securities over time. What will that really mean? And again, we're going to find out over the next few years. Last little economic stat for Britain that's important is that 1/3 of all foreign nationals who come into Britain live in London. And already, we've seen some of the property markets in London start to get a little bit soft over the last year or so. That's really a global impact more than it is Britain itself. But that's going to say something. Again, companies like eBay, Caterpillar, GE, their foreign headquarters are domiciled in London. If there are any kind of trade-related changes that cause them to move those headquarters, that's going to mean something for Britain's property markets, for Britain's real economy, etc. But stepping back a little bit here, and as we look at Europe in totality, the really two, if you will, economic strongmen of Europe have been Britain and Germany. So what we're really seeing here is that one of the strongmen, if you will, is stepping aside. Why has all this happened? Well, this really relates to the greater global economy, and it really relates to the central bankers more than not. And before we're done, I want to touch on what this may mean for the United States also. So as we look at what's happened in Europe, and this is really true in the United States too, over the last 7 years, politicians have really put, if you will, the onus on the central banks to cure this economic malaise we've been living through, to reinvigorate these global economies. But what they haven't done is they haven't made their own political or structural reforms. Now, quite honestly, as we look at Britain, one of the key issues was immigration. As we know right now in Europe, immigration is a hot potato issue. Had Britain stayed in the EU, they would have been mandated as to how many immigrants they should have taken in. It wouldn't have been their decision. It would have belonged to the EU. So in one sense, this isn't about central banks and printing money and interest rates. It's about determining, if you will, your own sovereign future. And England is saying, and Britain is saying, we want to determine that future. We don't want the EU doing that. Well, in one sense, that's caused a little bit of a political uproar, if you will, in England, and has been a point of contention for a long time. And although it's just my own personal comments, it really reflects on the United States too in terms of what's happening with Trump and disenfranchisement, if you will, of various wealth demographics and economic demographics. This is a global phenomenon. This isn't just Britain. This isn't just the United States. So, what does this mean for the U.S. as we look forward? Well, as we've talked about many times over the last few years, currencies are playing a very key role in not only economic outcomes, but financial market outcomes too. And when we remove Britain from that EU structure, if you will, that says something about the euro as a currency. It's losing, if you will, one of its underpinning economic strongmen. And what happens as we move forward? Well, just last night, there was an announcement in Italy that there's a $150 billion bank bailout bill. The banks in Italy are having trouble. If you've seen the stock charts of Deutsche Bank or Credit Suisse, over the last year or so, they look a lot like Lehman. A lot of reform has not taken place in the euro community. It's really only been the central bank who's come out printing money and dropping rates, etc. So one of the things we did see in the markets, that the markets didn't take that vote well. They really thought Britain would remain. We had an immediate 5% correction over 2 days. And what happened? Well, exactly the same thing that happened when we had a 10% correction in January. China devalued their currency. The U.S. Central Bank, Janet Yellen, came out and said they'd provide swap lines to Europe and European banks. That means more money, more liquidity. The ECB itself said that it would extend its buying of securities in the open market vis-a-vis its printing of money. And the Bank of England came out and said that they're probably going to drop rates this summer. So one more time, all of this has been on the back of the central bankers. But as we come back and think about the U.S. economy in conclusion, what does it really mean for the U.S. as we move forward? Well, I'm going to come back to, one more time, the importance of currencies. Over the last few years, the U.S. dollar has been very, very strong relative to foreign currencies. Now, it's great to have a strong currency, but we need to remember that a lot of the earnings that are being generated by corporations in the United States are being generated abroad. So when the dollar increases relative to foreign currencies, the revenue being generated abroad by a lot of these companies is declining in a declining currency. And immediately after the vote, the euro fell a little bit here. And looking forward, losing one of its strongmen, that's not a wonderfully happy sign for the euro as a currency itself. The dollar immediately rallied after the vote, and that's what we really need to keep an eye on here going forward. Because remember, as we've talked about in prior videos and prior writings, earnings globally are in decline right now. The second quarter of this year is going to see the 6th quarter in a row of declining S&P 500 corporate earnings. A stronger dollar is not what corporations need right now. But that may be, and probably will be, a fallout effect of the British vote. Finally, the Fed and the ability to reinvigorate the economy over time and interest rates. We've had a lot of false starts on interest rates since December of last year. You'll remember the Fed raised rates a quarter point. We got into a correction in January. All bets were off. We weren't going to do any more rate increases. But along came May. The economy's picking up a little bit better. The hints one more time from the Fed that they were going to start to raise rates again stopped a week later when we had a not wonderful payroll employment report, and all of a sudden, all bets are off. Well, after the British vote, it's a pretty darn good bet that we're not going to see any interest rate increases this year by the Fed at all. In fact, one of the Fed members came out and said we may not see any all the way through 2018. So in essence, it's kind of business as usual one more time. But the one thing, again, that we need to remember and we need to think about is not just the Fed, but really global central bankers. Have they exhausted all of their ammunition to help us in any kind of an economic global downturn or an earnings downturn? The Fed, at a quarter point on short-term interest rates, can only go to zero. And their MO in prior downturns has been to drop rates. Japan is in negative interest rate territory, Europe's in negative interest rate territory, and we're as close to zero as we can possibly get. So again, one of the key questions here as we move forward is if we continue to see pressure on the global economy and pressure on global earnings, what can the central bankers do from here? Do we do another QE4? We just don't know. But we hope this helps a little bit in not only understanding the reality of the real economy in Britain, the reality of the real economy in Europe, but also what those fallout impacts are for the global economy and the US specifically. This vote, although new, will be playing out over the next year or so because this is not an immediate, we're out of the EU on July 1st. There's an exit plan that takes a year or so we will see how this plays out, and we'll be talking about this more ahead. So again, we hope this is helpful in just looking at some of the key points of what has been a pretty darn big decision globally over the last week. On behalf of the entire team at Capital Planning Advisors, we very much appreciate your time and being with us. Thank you so much. We'll see you very soon.